Okay, I'll just check you guys can hear all right. Sounds like it needs a bit more. How is that? Is that okay for you guys over there? You sound okay? That's a nod. Do you want a bit more? Right. Okay, is that better? Is that better? And what about you guys up the back? You okay? You guys? Okay, good. Right, I think it's gone 12, so we'll make a start. So we're in the topic of the regulation of financial institutions, and we'll just briefly review what we did yesterday, and then we'll progress on from that point. Within the financial system, particularly for financial institutions that are financial intermediaries like banks, asymmetry of information is just the norm. And if you think about why that is, if you want to get services from a bank, say you want to get a loan from a bank, you go in, you provide a lot of data on yourself, financial data on either you as individual or family or company, and the bank evaluates that and then ultimately grants or not grants the loan as the case may be. But that information is held in confidence by the bank, so it's not provided to anyone else. And so if you want to assess the soundness of your bank that you bank with, you cannot get access to the data that you need. And so regulation is essentially a mechanism so that you can trust the financial institutions you're dealing with without having to actually go and personally verify that they are as strong as you would like them to be. And in that respect, regulation is largely prudential in nature. That means that the regulators are particularly concerned about the level of risk-taking today, and what they're trying to do is limit it, not eliminate it, but limit it so that as the financial system progresses in the future, it does not become unstable. So that's essentially the goal of it. We look briefly at why a bank may fail, and the way it fails is very similar to many other financial institutions. It can fail for one of two problems. One is illiquidity. That's the inability to disperse cash as necessary. For example, if people want to withdraw money from their accounts or they want to draw down a loan, if the bank cannot provide that, then it doesn't have a business. The second thing that can happen that puts a bank out of business is that it becomes insolvent. And that means that the liabilities are larger than the assets, and it simply it doesn't have enough assets to cover its liabilities, and it is broke, and that's insolvency. Now, in practice, illiquidity can lead to insolvency. So if a bank strikes a problem of illiquidity, it can lead to insolvency because what the bank then has to do is quickly sell some assets to restore the liquidity that's gone down. So if liquidity is drawn off, needs to restore it, they have to sell things quickly, and typically you will not get full value for those, and so you incur a loss on the sales that you make. So that can lead from one problem into the other. Another thing we talked about is what we call contagion, and that's a problem within the financial system, that if one institution has a problem, it doesn't necessarily have to completely fail, but it just has to have a problem. Often that problem will spread to other financial institutions, and the whole financial system will become unstable. And that's so when regulators are dealing with looking at the financial institutions, it's not just a case of looking at the individual institutions and seeing how strong they are. They have to understand the system and how a failure in one would then go and propagate and fail other ones. Now, when we're looking at the Australian system, APRA is their main prudential regulators. They have two systems that they use, which are to assess and then supervise the entities which they're looking after. The first thing is called PAIRS, and that stands for Probability and Impact Rating System. And the P in the probability is basically what is the probability that this particular institution will fail. And the I, the impact, is what impact will this system, will this institution have on the system if it did fail. And once it has that done, so this is the first thing, they got a rating out of that system, it then goes into a thing called SOARS, which is Supervisory Oversight and Response System. So what that does is it takes the output from the pairs, basically what's the probability this institution will fail, if it does, what's the impact on the financial system as a whole, and then that determines what the regulator will do in response. And it has 3 levels of response, 4 levels of response that it can take. First one is everything's normal. And so normal reporting just carries on as per usual. Typically, that's quarterly reporting. Sometimes it's even more quickly than that. Sometimes liquidity plans have to be reported on a monthly basis. But it's just the normal reporting that goes on within the financial system. The next level up beyond that is what they call oversight. And all you have to have is one problem in your financial institution for you to get moved out of normal up into oversight. And then they have more frequent reporting, and they're starting to look at ways of restoring the financial institution to health. Now, if it gets more serious than that, the next one up is mandated improvement. So this is when it's not just giving you guidance about your financial institution, how to restore it to health, is that they can issue a legally enforceable directive to actually fix problems. And then if it goes beyond that, the last one that they have is the ability to restructure the institution. They can replace top management. They can actually bring in new shareholders. They can require them things like raise extra capital. So they have considerable powers, and the idea is that we want all of our institutions to be normal. We don't want them to have problems, and the system is there to find problems early, get them fixed, so it doesn't develop into a problem. And so this brings us to bank capital, which is one of the key things that regulators throughout the world look at. So when we talk about capital adequacy for a financial institution, what is it? We'll ask the question, why is it important? What's capital adequacy when you're talking about a financial institution like a bank or other similar institution? Go ahead.
Like banks having enough capital money, like it's bank relative to how risky.
Okay, so it's how much money they have relative to their risk. How much they need to hold. So that this is, when you talk about adequacy, there's some defined standard, how much money they have to hold relative to their risk. Yeah, so let's look at the structure of how a bank is actually structured. Look at its balance sheet and see how, where the stuff sits in here. So, a little picture of how, let's say, let's turn this on, put that one over that side. Okay, so the basic structure of a bank's balance sheet, not that much different to any old company. So there's two parts to it. There's the assets, and that's basically what the company has done with the funds that it's raised to go about its business. And then the second part of it, on the other side, is where did it get the money from? And typically, it's equity plus liabilities, and those liabilities are typically borrowings of various sorts. So as long as the company is functioning, those two things are identical in size. If it turns out that the assets are bigger than the equity plus liabilities, that means you have no equity, in fact you have negative equity, and you're broke. But we're going to look at a normal bank just trundling along, doing its business. So in terms of the assets, one of the things they'll have is they'll have some stuff for liquidity purposes. And that can be things like money market securities, which they've bought and can be resold quickly. They may hold government bonds, for example, for use in repos if they need to raise liquidity in a hurry. So that's the first piece of their balance sheet. The biggest piece that they're going to have on their balance sheet in terms of assets is their loans. So this is where they make their money. And so most of the balance sheet is loans. And then there's two other pieces to it. Again, they're much smaller. There's this piece called investments. And this is basically money that they have but haven't found a good loan for. And typically in that, they'll hold some bonds. And then there's everything else like, if they own premises, real estate, and then, maybe their computer systems. They're all assets, but they don't form a large part of the balance sheet. So that's one side of the balance sheet. And in a going concern, things are running along. The other side is exactly equal in size. And again, it's composed of a bunch of pieces. So if we split it off here into several pieces, up here will be equity. And what that is the owner's funds. So this is the money that's essentially being provided by the owners either directly when they bought the shares, or there's been earnings which has not been distributed and they've kept inside the bank to help the thing grow. Now, there is another group in there, and we'll come to exactly what these things are. And these are other capital. And then where they get the rest of their money is just normal bank business. You know, there'll be some transaction accounts. Probably be a chunk of term deposits. There will be money market securities that they have issued themselves, and possibly any bonds that they've issued. So that's where, in one sense, this is where the money comes from to do the business, and this is what they have done with that money. So the thing that makes a bank different to other businesses is the ratio of that equity to the borrowings. Typically, we're looking at like 93% of the funds that they have been borrowed in one form or another. So typically, 93% maybe is this piece down here, and the other bit's up there. So when we're talking about capital adequacy, it's really about how much of this top bit, the equity plus this other capital, do they have relative to the risk that they're taking on this side of the balance sheet. And let's think what might happen. So there's a whole bunch of loans out there. Let's say, for example, one of those loans goes bad, and say it's this loan in here. It goes bad and goes defaults on them. So they've lost money on that. So there's a default on this loan. Okay? Now, we've said, as long as things is going, those two sides of the balance sheet, the assets and the liabilities, are identical in size. So if we have a loss on the asset side shrinks in size. If we have a loss, we don't have as much assets, things shrunk. What shrinks on the equity plus liability side? Something's got to shrink over there to compensate for the fact that we've lost value on the asset side. Where does the loss occur on the other side? Yeah, go ahead. Yeah, the first place it comes from is equity. If necessary, it can be written off against the other capital. But really, this is where it comes from. It comes up here. And so that's where the loss is. The default here results in a loss of capital. And the more risk you take over here on your asset side, the more likely you are to get losses. And so from a regulator's point of view, what they want to look at is how much risk do you have on your balance sheet, and then work out from that how much capital should you have for the level of risk that you're taking. Okay, any question on this before we move on? Okay, so this is a basic deal. That capital is there to absorb losses, and so that this other stuff, transaction accounts, term deposits, money market issues, and bonds issued, if it comes down here and start eating into that, then you're out of business. While it's eating into this, you can keep going. And so this stuff up here is the protection that is there for all these people down here. This, which is the capital, protects the depositors and people who have taken on their debt. So losses occur up here first, and it's there to protect against losses down here. So hopefully from that you can see why this stuff is important and why a regulator is interested in it, because it's that protection against these other people losing their money. So when we started looking at where does all this stuff come from, they started back in the 70s with it, but there's been these international agreements called the Basel Accords. There have been 3 of them. We're on Basel III at the moment, which have been international guidelines about how capital should be both measured and then how much is required. And the bare minimum is 8%. But it is not 8% of assets. It is 8% relative to risk-adjusted assets. And we'll come to exactly how we do the risk adjustments. And it's got to be at least 8%. Now, these are the 3 Basel Accords that we've been through as time's gone by. Now, the very first one, the Basel I, was quite simple. It was simply 6% of total assets. So the calculation was quite straightforward. As you looked at the assets you had, 6% of that was your capital that you required. Now, what people thought was a good idea was that not all banks are equally risky. So let's think of 2 banks. Let's say one bank, both simple banks, they only make one type of loan. Bank number 1 makes first mortgage loans. That's all it does. Bank 2, all it does is makes loans to people who want to buy second-hand vehicles. Which is more risky? Mortgage bank or car bank? Which is more risky? Mortgage bank. Car bank. Okay, how many think the mortgage bank is the most risky? Got 1. Okay. How many think the car bank is more risky? Yeah. Okay. And basically, that's true. If you think about mortgages on land and buildings, typically over long periods of time they appreciate in value. Whereas as soon as you drive that car off the lot, it loses several $1,000s and continues to depreciate until such time it ends up at the wreckers. And so the chances of car bank losing money is greater than mortgage bank. And so, if you were a regulator, which one would you want to have more capital? Mortgage bank or car bank? Car bank, yeah. It's taking more risk, therefore you want that bank to hold more capital simply because of the risk that it has on its balance sheet. And so that was the major innovation in Basel II, is that they put in a whole lot of new ways of measuring the riskiness, and then out of that, you could calculate your requirements. Now, there were people who said, this is a bad idea. And here's one person who did say it was a bad idea. She wrote a fat book about it. This book here, Bull by the Horns by Sheila Bair. She was at FDIC, that's the Federal Deposit Insurance Corporation. That is the U.S. depository insurance company owned by the government. And she was the chairman of that for 5 years. It was a government appointee. She was appointed by the second President Bush for a 5-year term. They're always 5-year terms, so she got a 5-year term. And then she carried on. She was in that role through the crisis period and ended her role well into the Obama administration. Now, all these financial crisis books, they're all very self-serving, and this is no exception. She's trying to paint herself in a very good light and painting everybody else as bad. But even that aside, some of this stuff is really interesting if you are interested in banking. And she was one of the people that said that the idea of risk weighting was a bad idea and that you shouldn't do it. And what actually happened in the United States is that they did not go on to Basel II except for their top 20 banks. The top 20 banks, because they were international in scope, they said, okay, we'll make these ones that comply with this, but we'll stay on Basel I for absolutely everything else. And what actually happened, when you think about it, and we'll sort of look about how this could come about, is that the amount of capital required to be held by banks was actually reduced between Basel I and Basel II, And when we think about what that means that Basel II weakened the banks. That's the argument that she made at the time, and she explains it all in her book about why it weakened the banks and why the U.S. did not go into Basel II apart from the very largest ones, because it, across the board, weakened the banks. And then Basel III, which was negotiated, she was actually one of the negotiators for the U.S. Team, came into force in 2010, and basically it tried to fix all the problems of Basel II. It started raising all these requirements, actually raised a lot of the risk weightings, so that banks then had to carry more capital. Now, some new things that were not there before, these two, the countercyclical buffer and the conservation buffer. The countercyclical buffer has not been implemented in New Zealand yet, but we do have the conservation buffer in place. So this is New Zealand banks. This is them as a group. And the idea behind the conservation buffer is this. The regulatory minimum may well be 8%, but you should never run a bank close to the minimum. You should have more. And so the 2.5%, the size of the conservation capital, that capital buffer is 2%. It's up to the discretion of the local regulator to actually set what it is, but it's between 0 and 2.5%. And that basically says this is how far you should be above the 8%. You shouldn't be running your bank close to the minimum. And so when you looked at what happened here, we went on Basel II here at this point, and so the core minimum of Tier 1 capital, we'll come to exactly what it is fairly soon, went up, and then they phased in the conservation buffer. And so currently, if you're a New Zealand bank, you have to have 8.5% Tier 1 capital. And if you look at how it's distributed across the 5 main banks, about what they've got in terms of their capital, this gray stuff down here, this is the what we call core equity Tier 1. This is simply the equity. You know, when we drew that picture before, you know, the owner's funds, and there's other capital, the equity is by far the biggest piece of the capital. There are other things, we'll come to what they are. And there's various lines here showing where the minimums are. But, you know, all New Zealand banks, well, these are 4 big ones plus Kiwibank, they're well above the minimums. Now, the other thing that's there, the countercyclical buffer, which we have not implemented yet, and under the Basel III agreement, you don't have to implement that until 2019, is an idea that is quite simple, is that when times are good, you should be building your capital up as a bank. When times are bad, you will be allowed to run it down at a controlled rate. So it's simply, and that's why they call it countercyclical. Good times, you raise it, your capital. Bad time comes, you'll be allowed to run it down. And at the moment, we haven't implemented that, but under the agreement, by 2019, we will. So both Australia and New Zealand are fully on Basel III from 2013. Unfortunately, the book was written before this, and so it has very little on the Basel III agreement. Any question on that before we move on? Yeah, go ahead.
I thought that the countercyclical is the opposite line. It's that if the situation goes good, that you have less. That if the situation is bad, you have more.
Okay, so right. What this does, why it's called countercyclical, is if you think about, where's my balance sheet again? There's my balance sheet. I'll put my balance sheet up again. If you are required by the regulator to hold more and more of this stuff, okay, more capital, that means you can actually make less loans. So what they're essentially saying there is why it's countercyclical is, although, yes, you are building up the size of your capital, what that does is restrict the growth of your loan portfolio. So that's what's being restricted. That's the thing that's countercyclical. When things go bad and you start to run your capital down, it actually allows you to keep your loan portfolio at least the same size or maybe even grow it a bit. So that's why it's called, it's not, yeah, you're right that the size of the capital goes up and down with good and bad, but the size of your loans goes the opposite direction. In the good times, it restricts the growth of your loans, and the bad times, it allows you to expand them. Okay, so that's where the counter-cyclical thinking is on the asset side, not on the equity side. Okay, any other questions? Yep, you got another one?
I've noticed that you said that the bank has to issue shares in order to have this owners fund. So in this case, if they, for example, if they try to maintain like 6% of the share price like so, does it mean that they have to issue more new shares in order to get 6%?
No, the equity is the money that's been brought into the company, okay, by the issue of the shares. And once it goes onto the secondary market, the price of the shares there going up and down doesn't affect the equity here. Okay, usually it's the other way around. Equity here drives the share price. So they don't have to, if the share price drops, they don't have to issue more shares to acquire more equity. Okay? Okay, so we'll move along. Okay, so when you do this calculation, there's these two tiers. There's two tiers, tier 1 and 2, very highly informative names. What are tier 1 and tier 2 capital? Anyone have any ideas? Oh, go ahead.
Assume the tier 1 is the ones you sort of is the owners the second tier, like what's the other capital?
Okay. Well, of tier 1, the owners' funds, the equity is by far the largest piece, but there are other things in there. Tier 2 is actually what we call lower quality capital. So that was for my picture. So the basic difference between them in terms of how it affects a bank is that this group here, the tier 1, basically the bank has unrestricted access to this, and it can use it at any point to write off losses in its loan portfolio. And so the most obvious one is like when we drew the picture of the thing, is if there's losses here, they can immediately write it off against the equity, and in other pieces in tier 1, they can immediately write off a loss directly against that. Now, the tier 2 is it's called supplemental capital, and the basic deal about tier 2 is that you cannot access stuff almost straight away. If you want to access this, you often have to do something to get hold of it. And for example, that one there, mandatory convertible debt. Often you'll find in the debt contract, whatever it is, it's mandatory convertible. That means it will some stage convert to equity. But typically it will specify which particular, maybe once a year, this can happen. And so to get hold of it, to write off losses on your assets, is not a straightforward process. You often have to wait. It takes time. And then, say it reaches the date when it's convertible, then you have to get them to convert. And so, although it will be available for writing off losses, it's not immediately available now. And some of this stuff isn't even what we would normally consider to be capital. Like, for example, subordinated notes and debentures, they're actually debt. I mean, the mandatory convertible debt is debt as well. And so, normally, if you try to grab this stuff too early, you put yourself in the situation of default. And if you look about how much we have, like if you look at our New Zealand banks, how much it has of tier 1 and tier 2 capital, tier 2 is the blue stuff, and they have very little tier 2. I mean, across the 4 major banks plus Kiwi Bank, most of them don't have much tier 2, and that's how you want it. Okay, tier 2 can be useful in a really, really serious situation. But you don't want banks carrying a lot of it because it's hard to get hold of if you actually need it. And that's one of the things we found in the financial crisis, is that people had a lot of Tier 2 capital, and then they found that when they needed it, they couldn't actually use it. For example, if it was mandatory convertible debt, they couldn't get it quick enough to actually write off losses against it. I see some puzzled looks up there. People got questions? Oh, everybody's happy. Okay, so when you're doing the calculation, the numerator, that's the bit on the top, is the capital, and that's as defined by those prudential statements from your regulator. And you split them into Tier 1 and Tier 2. In fact, this number has actually changed. This number is now 75%. So Tier 1 has to now be 75%. That's up from 50 in Basel 2. So that's stuff they can use straight away. There's a list of various things, and when you think about what the difference, paid up shares, general reserves, that's money that they've got, hasn't been used for anything else. Retained earnings, so if you have earnings that you have not paid out as dividends, you can see how these are all straight away. If you need to write off a loss, you can write them off against these ones. When you look at these other ones, like preference shares, mandatory convertible notes is debt. This one definitely says debt. Debt there. Limited life redeemable preference shares. It just takes time to get hold of this stuff, and that's why it sits in Tier 2. And from the regulator's point of view, they don't want you holding lots of that simply because of the problems it creates if you have to use it. Now, going on to risk weighting. So why do they risk weight things? Told you a little while ago. Why do they risk weight? Why do they risk weight things? No. Oh, I told you just a minute ago. Well, not a minute ago. 5 minutes ago. 10 minutes ago. Yep. Go ahead.
Calculate the OCC.
What's that? Opportunity cost of capital. Actually, it's basically the more risk you take, the more likely you're going to make a loss. And so, if you think about why we have capital, it's to absorb those losses. If you've got higher risk, the regulator wants you to have more capital in case those risks come back to bite you. That's why it's there. Now, when we actually look at what they do, what it reflects is, it says reflects the counterpart risk. And basically, this is the probability that this stuff is going to default. So whatever your asset is, it looks at the probability of default. And the other thing it looks at is if you've got any collateral. For example, if you're looking at a mortgage, if your first mortgage, the collateral is the land and buildings that the mortgage has taken out over. So there's two things. One is the probability that it will default. In the event that it does default, are there assets there that can go as seized to try to recover the funds? So there's your basic thing, how you do it. You estimate the capital base. That's defined by the regulator, exactly what that is. You calculate it. Then you calculate these risk-weighted assets and your credit risk for, now we'll come to what off-balance sheet items are soon, and then you simply divide one by the other, and you have to be at least 10%, and of course with that extra conservation buffer in New Zealand, you have to now be at 10.5. So let's see how this would work, how this actually affects us as a bank in how much capital we have. So we're going to look at a set of assets here, and then we're going to say, what's the minimum capital required for this asset? And we'll do it at 8%. And then maximum debt that we can incur to buy the asset. So the first one up, if we look at the risk weighting zeros, now come back to, there we go, okay, so hopefully now, I'll put it up there, you can see it. For example, let's take the Commonwealth Government debt securities. So let's say they buy, or they want to buy a government bond, and we'll make all the assets, make them all $100,000 each, all of them. as we go down here. So government bond. Now, after risk weighting, what is its value? After this, it's 100,000 before risk weighting. Risk weight is 0%. It's 0. Okay? So in terms of the risk weighting for the purpose of the regulator, nothing. So what is the minimum amount of capital you have to have? 0. So you don't have to have any capital to buy one of these. And the maximum debt that you can incur to buy it is obviously 100,000. 100,000. You can basically borrow every last penny you need to buy this government bond. You don't have to put any money in as far as capital. So that's your risk weighting of 0. And if you think about why it has a risk weighting of 0, at least in theory why it has a risk weighting of 0, is that we assume under these things will not default. Like vault cash, notes, and coins, people might get stolen, but it won't default. Okay, so the next risk weighting here is 20%, corporate bonds with AA. So let's say they're going to buy an AA corporate bond. So after risk weighting, what's the value of this $100,000 of AA rated corporate bonds? Not 2,000, 20,000. Yeah. So after risk weighting, it's worth $20,000. So in terms of how much capital, what's the minimum amount of capital we have to hold now for this bond at 8%? No, it's 8% of 20,000. Okay. After the risk weighting is going, it has taken $100,000. 20% risk weighting is turning into $20,000. You have to hold 8% capital, and that's actually only $1,600. Which means that you can borrow $98,400 to fund that asset. Okay, going to the next group up, here's some housing loans. So we'll have, a first mortgage here. And $100,000 first mortgage. After risk weighting, what is it actually worth? After risk weighting, $100,000 turns into? Yeah, $50,000. So in terms of risk weighting, this thing goes on our balance sheet as a risk weight of $50,000. And at an 8% minimum capital, what do we have to put up as our bare minimum to fund this mortgage? 4,800. $4,000. That's 4,000. Yeah, let's rather call it 4,000. We'll call it 4,000. Okay, so you got to put up 4,000 bare minimum of equity, and that means that you can actually borrow, in terms of deposits and money market securities and whatever, $96,000 to fund this. So as you can see, to actually fund 100,000, 4,000 in capital, 96,000 in borrowings of various sorts, and that gives you 100,000 for loan. And when we did risk weighting. So when we go up to the next group here, 100%. So let's go for a BBB bond. BBB bond, and $100,000 of that. And after risk weighting, what is it worth? It is 100,000. Okay, so 100% weighting is 100,000, which means how much capital you have to hold, bare minimum, 8,000. And that means that you can then borrow a maximum of 92,000 to fund the purchase of this bond. Now, because most of the stuff is Basel II, I don't think there were any risk weightings higher than that. There are now more risk weightings that go up as high as 200%. And where's my other chart gone? Here it is. Like for example, this is stuff around mortgage loans. So for example, category 2 with a very high loan to value ratio greater than 90% has a 200% risk weighting on it now. So let's, even though this is Basel III, we'll do a 200% one. So this is what we'll just call a risky mortgage, 100,000 risky mortgage. After risk weighting, what does the risk weight turn this thing into? Yeah, $200,000 is after risk weighting, which means how much capital you have to hold bare minimum, 16,000, and that still means that you can borrow, 84,000 to fund this asset on your register. So this is how the risk weighting worked, and when you went from Basel I to 2. One way of looking at it is everything was at 100% in Basel I, and then every risk category that introduced had a maximum of 100. And so they had a lower amount of capital. One thing they did do, they raised the capital requirement from 6% in Basel I to a bare minimum of 8 in Basel II, but it actually wasn't enough to offset the fact that by risk weighting the assets, the total capital held by virtually every single bank that went on to Basel II was lower than under Basel I, and that weakened the banks. Okay, any question on this before we chug on a bit further? Yeah, go ahead.
Is this kind of the minimum capital and it's quite similar to the capital structure of the company?
Yeah, because in actual fact, probably 3/4 of all capital is equity. Okay, in terms of regulatory capital, probably 3/4, maybe even more, is actually equity. And so it's when we're talking about capital structure of companies, the balance sheet in one sense really isn't that much different. It's just that there's not much equity there and there's vast amounts of borrowing. Whereas you look at a normal company, it's unusual to have more than, say, 40% borrowings, 60% equity and 40% borrowing, but considering lots of borrowing relative to equity. Whereas here, it's, like 93 versus 7, So they have very little equity relative to the other stuff they have. Okay, any other questions? Okay. So this picture. Now, there are other things that you have to hold capital for, not just the on-balance sheet risk. There's these other ones. So when we talk about off-balance sheet items for a bank, what do we mean by an off-balance sheet item? And then we're going to ask, why do you have to hold capital if it's not on your balance sheet? What's an off-balance sheet item? Any ideas? What it might be? Yep, go ahead. Difference between book value and market value. Those things normally on balance sheet. Okay, so when we're talking about off-balance sheet items, essentially they're either what we call a contingent asset or contingent liabilities. And an example of one is that, let's say, for example, a bank's going to make a loan. And so a person comes in and they apply and say they're going to borrow $500,000, and the bank grants the loan. So what that $500,000 loan is at this point is an off-balance sheet item because it's been approved, but the person hasn't actually come and got the money. So what will happen, I hope, because they made the loan, is that someone's going to draw that money down. And let's say, for example, someone's going to borrow that money because they want to build a house. And typically what you have to do is you make a down payment to the builder, and then you make progress payments as you go along. And let's say, for example, of this $500,000, the builder wants $50,000 up front. And so they draw down $50,000 and pay that. At that point, what happens is that the $500,000, which was the off-balance sheet items, gets split into pieces. the 50,000 being drawn down now moves over to the asset register and becomes an on-balance sheet item, and the remaining 450,000 is still an off-balance sheet item. And hopefully, they'll borrow more. Now they'll draw down their loan, and gradually this off-balance sheet item will move over onto the balance sheet. And so, why you need to hold capital for this stuff is because although they may be off-balance sheet as a contingent either liability or asset, what you expect is that they will come on balance sheet, and basically it's proactively asking you to hold capital for these items. So moving along, and again, they're risk weighted. They're not all at 100%. So if you have any commitment which can be unconditionally revoked, typically something like an overdraft facility on a checking account which is not being used, a bank can say, I'm turning that off. And so that has a risk weighting of 0. So even though, say, a bank may have granted someone an ability to, say, draw down 100,000 in overdraft, if they haven't used it, typically say, you can't use it, and turn it off. And under those circumstances, the risk weighting is 0. Things like 20% trade-related, remember the bank accepted bills? They tend to go in this category. And short-term commitments, like if you have, for example, typically with a overdraft facility, you typically have to clear that once a year. So actually you have to bring it down to 0. So if someone is using their overdraft and you can't pull it out from under them, but they have to clear that balance once a year, then it only goes into risk weighting of 20%. And the other risk weightings go up, long-term ones over a year. Remember we talked about bank lines of credit and underwriting of issue of securities, money market securities. They're at 50%. And these ones here, like for example, 100% commitments where the drawdown is certain. If they know that they made a commitment, say for a loan or something, and they know that it's going to be drawn down, that gets rated at 100%. So you do the risk weighting on these things as well. So there's often typically a number of assets that are off balance sheet that will materialize, become on balance sheet. You risk weight those up, and they go into your calculation of how much you need to hold. Right, I think we're sort of almost out of time here. Do you have a question? Yeah?
Yeah, just wondering what is off-balance sheet items. What's the difference between this one and some companies, they have a low-risk account on balance sheet? What's the difference between this and that?
What's the thing that's off balance sheet on?
I'm not quite sure, but recently I have a kind of I did a little bit digging about that. It says like some companies, if they, for example, if they expect that they're going to do a new project coming, so they just reserve some money
Yeah.
balance sheet
Yeah.
just for future use.
Yeah, I mean, in terms of calculating how much capital you have to have, there are things called reserve accounts, which is money that has been set aside for specific future use. And in the calculation of how much capital you have, the reserves do go into that. So that's probably equivalent to these things.
So okay. Is it the same as the off-balance sheet item?
No, those are on balance sheet. The reserve accounts are on balance sheet, and they actually form part of the capital that they have. Okay, so if you want to ask any questions, I'll be around for a few minutes. Otherwise, we'll pick it up at this point tomorrow, and hopefully we'll finish it off tomorrow. dental visor. So basically what you do is you just stick this on close, where close to where your mouth is.